Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
This is ETF Market Insights. I'm Danielle Nuzzle from BMO Exchange Traded Funds. Thanks so much for joining us again today. Whether you're joining from our YouTube channel or live on GoToWebinar, it's so great to have you back on this Friday afternoon. As a reminder, before we get started, we are not providing you any advice today, no investment advice. We're not giving you any investment recommendations. Today's session is all about providing information for do-it-yourself investors to really empower them, to give them the tools to manage their own investment portfolios. Our friends from Investorline are here today, and they have an exciting promotion that they're going to share with you later in the show. So the same story for Investorline. They're not here to provide you any recommendations. They're not here to provide you any advice. They're just here to provide you information and, of course, that great promo that we'll get to at the end of the show. Well, today's speakers, we have Alfred Lee from BMO Exchange Traded Funds. Alfred is an overall ETF expert, but of course also an ETF portfolio manager. Alfred, it's so great to have you on the show today.
Great to be back. Thanks for having me.
So today's topic is building a fixed income portfolio. Before we get into that, we want to remind everybody, subscribe to our YouTube channel. We have a lot of great content there on demand. And of course, if you turn your notifications on, you'll be notified every Friday at 1 o'clock Eastern when we go live, so you can watch a live stream of the event. Now, our 1-minute ETF update today. So this comes from the National Bank Flows Report. This is a monthly report we get at BMO. So thanks to our friends at National for putting it together. What I thought we could take a quick peek at are flows into fixed income ETFs so far year to date. And what we've seen, even though we've seen a very challenging environment for fixed income so far this year, we'll get into why that is in a second, we are still seeing money going into fixed income ETFs. There is still use for fixed income ETFs in portfolios. And in fact, we saw $2.5 billion go into fixed income ETFs in Canada so far this year. Interesting to see, though, if you break down the segments or the different types of fixed income ETFs, we're really seeing that broad base aggregate exposure, something like a ZAG, taking almost the lion's share of flows of 1.5 billion. And then also interesting to note that cash alternative ETFs, which we talked about a few weeks ago with Alfred on our show, have also been seeing some flows as well. So just thought I'd share that with you. Now, Alfred, let's unpack what's going on in the fixed income market so far this year. We have had the worst Q1 and Q2, I think, for fixed income in over 30 years. This chart just kind of shows the different segments of the fixed income market, calendar years and so far year to date. Alfred, can you provide an update and just tell us what's going on in the fixed income space and how are returns different amongst the different segments?
Sure. Obviously, very troubled year in this year so far for fixed income. Obviously, I think the major headwind has been central banks obviously fighting inflation. So they've been aggressively raising interest rates over the last year, not just doing quarter point hikes, but also doing 50 basis point hikes, potentially doing 75 basis point hikes somewhere in the future as well. So, inflation and, interest rate hikes that we haven't seen in 20 years. It's been interesting because I think this chart is a good illustration in terms of, the benefits of diversification, but also illustrates, how the fixed income market has been moving around year to year. I think you actually put together this chart, but typically it's applied to, commodities, equity sectors and different equity regions as well. But I think it's very useful for fixed income as well, because on a year-to-year basis, it shows you how different parts of the fixed income market could outperform, underperform. And then you mentioned, with the aggregate bond taking the lion's share of flows for good reason. I mean, when you look at, the aggregate fund performance in this jelly bean chart, as you call it, typically what you'll find, it tends to be middle of the pack. So for asset allocators, for fixed income users, it tends to be used for that very reason, because it tends to be your steady eddy and it tends to mitigate a lot of that volatility in the fixed income market.
And even if our viewers today want to come back to the episode and just click pause on this screen to really digest and understand what's going on, because there is a lot of information, but it's quite useful. There is an ETF that matches up to each of these segments of the fixed income market. So if you're an investor who's thinking, I want to be a little more tactical with my fixed income portfolio, I'd like to, zero in on the short end of the curve, or maybe get a little more defensive and only get into government bonds, there is an ETF that will match each one of those exposures. And you can see with these returns is every year, depending on the market cycle, depending on what's going on with rates and inflations, different areas of the fixed income market will outperform others. And of course, the orange box, which says AG, that's the aggregate. So that's all of the segments combined against something like a ZAG ETF. And that usually is pretty steady amongst the middle of the pack each year in terms of performance. So a really good visual to explain that. Now, ETFs are a really great tool for investors to access the fixed income market. Well, why is that? Because you, as a DIY investor, it's very, very difficult to go out and buy a bond. Bonds don't trade on the exchange. They trade over the counter, OTC. You might have heard this term, and you need to go through a broker to access bonds. So very, very difficult, but with ETFs, which has been a very, very big benefit, you can access a basket of bonds. You get that liquidity with an ETF. It trades over the exchange, and you can add fixed income to your portfolio very efficiently, cost effectively. You can access all different areas of the fixed income market, whether it's different segments of the Canadian market that we showed on the last slide, or you have, US corporate bonds, high yield bonds, US treasuries, discount bonds, emerging market bonds. There's so many other different areas of the market you're able to capture. And historically, this has been only institutions, maybe advisors, have been able to manage the fixed income portfolio in this space. But with ETFs, now do-it-yourself investors also have those tools if they choose to use them. Now, Alfred, we got a lot of questions actually on this, so I thought I would just put it in a slide and right up front. When investors are doing their due diligence on a fixed income ETF, 3 of the main characteristics or main kind of things that they're looking at are yield to maturity, coupon, and duration. Can you explain what these are for us and how an investor should be looking at those numbers?
Yeah, for sure. So I think these are, the main metrics that investors should be looking at when they're looking at fixed income. So yield to maturity applies to not just, single individual bonds, but also when you hold a bond ETF or a bond mutual fund, there's going to be an aggregate weighted average yield to maturity as well. So that's very important. So that's essentially a total return over the lifetime or the holding of your bond investment. So not only does it include the coupon payments over the period on an annualized basis, but also the difference between your purchase price and that maturity value of the bond as well. So, a good example is that over the last couple of years, as interest rates were moving lower and lower, the problem with the bond market is that a lot of the bonds were trading at a premium. So let's say if you bought a bond at, $1.05 or $105, that means, over the lifetime of the bond, it's going to mature eventually at 100. So you're going to receive your coupon payments, but also that value of the bond is going to go from 105 to 100 between your purchase date and that maturity date. So it also, takes into account the drift between your purchase price and your maturity value of that bond. The good thing, however, is that, as interest rates have gone up over the last couple of months, definitely very painful for the bond market. But the good thing is that it's provided a recalibration to the bond market where a lot of the bonds are trading at a discount now. So not only are you receiving the coupon payments over time, but also the purchase price, a lot of them are trading at, a discount. So you're also getting the appreciation of the bond price between your purchase price and also that maturity value as well. So that's what the yield to maturity is. It's more an accurate measure than just current yield. In addition to that, there's coupon as well. So that's usually expressed as a percentage. So it's a 3% coupon. That's basically, you receive a 3% annualized coupon over the lifetime of the bond. And duration, I would say, is one of the key metrics where it looks at the interest rate sensitivity of that investment. So typically the main determinant in terms of duration is the length of the bond or the maturity, the length of term to maturity of that bond. So take, for example, if you have two bonds, one that matures in 5 years, one that matures in 10 years, both with the 3% coupon, that longer dated bond, so that 10-year bond is going to be more interest rate sensitive, or it's going to have a longer duration because you're locked into a rate for a longer period of time.
Thanks, Alfred, for going through those key terms for us. They're really important for investors to understand when they're analyzing different fixed income ETFs. Now let's dive a little deeper into the areas of the fixed income market and what's going on so far year to date. So one of the most important things you look at if you're a fixed income analyst is the credit market. You look at things like credit spreads. So Alfred, what are you seeing in credit right now? How is this looking for 2022 so far?
So credit spreads have definitely widened out over the last, I would say, several months, especially after the invasion of Russia into Ukraine. We got inversion of the U.S. yield curve, which spooked a lot of investors as well. So as a result of that, credit spreads have widened. So think of credit spreads as an additional yield that investors want to compensate them for taking on the credit risk of either investing in provincial bonds or either investing in corporate bonds as a whole. So when you look at individual corporate bond, for example, that additional yield is going to be the credit spread above and beyond, let's say, a risk-free security like a federally issued bond or a U.S. Treasury in the U.S. So keep in mind that's going to change over time as macroeconomic conditions change, as the default risk of that specific security changes as well. But the wider the credit spreads, the more risk there is. So obviously, with concerns about economic growth slowing at this point, credit spreads have obviously widened out in the last couple of months.
And when we just look at this chart here, we see the spike in credit spreads, which happened in around end of April or March of 2020. No surprise there. That's when we first got news of COVID-19 and everything was shutting down. So a good visual there to see in times of economic stress, those spreads really widening and then tightening when there's more optimism around markets. Now, another consideration investors should make when thinking about managing their fixed income portfolios is the yield curve. So Alfred, maybe just give us a brief description. What's the yield curve and what should we be watching on the yield curve as it moves around?
Sure. So the yield curve is essentially the yield of the same bond plotted across different terms. So a lot of people, when they look at yields, they essentially think that whether it's short-term yields or midterm yields or long-term yields, they think that they're going to move in the same direction. For the most part, they do, but there are certain times where they move in different directions. So short-term yields will move down, whereas long-term yields would be moving up, or vice versa. So that's very important. But also keep in mind that the magnitude of the moves. So sometimes the short end is going to move less than the long end. So it's a very dynamic, there's a lot of dynamic forces at play. It does give you a very good indication in terms of what the market is feeling about the economy at that certain time. But that's one thing to keep in mind: the magnitude of the moves, and also the difference between short-term rates and also long-term rates. That does give you a lot of indication in terms of what the market is feeling about the economy at that time.
Thanks, Alfred, and just a really good another image here to show our viewers to kind of illustrate what you've been talking about. What we've done is we've plotted the yield curve as of basically this week, which is the green line. The red line is this week, the green line is a year ago today, and then the blue line is 6 months ago. So this is what the yield curve looks like. And so to Alfred's point, you can see how it's really moved. Some parts of the curve, the shorter end, more closer to the left-hand side, has gotten steeper or flatter. Now what a lot of people are looking at, or a lot of analysts, are that longer end of the curve. So if you look at the red line here, which is the curve as of this week, the longer end is actually starting to invert or slope downwards, which could signal a recession. And what this is really just saying is, as rates are rising right now, a lot of economists or analysts are seeing that not being sustainable in the very long term, and perhaps a recession or a market downturn is on the horizon 3-5 years ahead or longer, which would indicate rates going down, which would indicate the yield curve sloping down or inverting. So that's a good visual to show you there. Inflation. Alfred, I think we have not stopped talking about inflation. It is like the #1 topic, I think, of the year. But how does inflation affect fixed income portfolios?
Inflation has definitely been very topical. I think you're absolutely right. I feel like we've been talking about it for the last 2 years, but for good reason. I mean, inflation affects everything. You feel at the gas pumps, your everyday life. But in terms of fixed income, I would say fixed income is very sensitive to inflation because, think of it as, as the name implies, it's fixed income, right? So if you're receiving, a fixed rate of 3%, but your inflation is 4%, that means on an inflation adjusted basis, you're actually receiving -1%. So inflation to the fixed income market is very important. The fixed income market is always looking at inflation just in terms of looking at what the real yield of an investment is. So typically when you look at investment, the most common measure tends to be CPI, the Consumer Price Index. The drawback of CPI is that it is a backward-looking measure. Even though it gets changed, time to time by government agencies, it is reported and it is more of a backward-looking measure. The fixed income market does have a forward-looking measure, which is called the break-even rate, which is really the difference between the yield on an inflation-protected security like TIPS or real return bonds in Canada versus a notional plain vanilla bond. So think of break-even rates as the market's expectation for inflation. So it's more of a forward-looking measure. So also look at it as a hurdle rate. So if you believe inflation is going to come in higher than break even, you're better off being in an inflation protected security like TIPS or a real return bond. If you think inflation is going to come in lower than that break even rate, then you're better off in a plain vanilla notional bond because you think the market has overpriced inflation.
Thanks for going through that break even rate. It's a really important metric for investors who are thinking about adding an inflation hedge to their portfolio. Really important metric for them to understand. And if you're thinking about adding like a Z tip or something that's an inflation hedge to your portfolio, you need to have a little bit of a conviction, a little bit of a stance on where you think inflation is going based on that break-even rate. And then I'm also going to mention duration as well. Know the duration for your products. On the ETF that you're buying. Shorter duration tends to eliminate some of that interest rate risk and creates a little less volatility. So just a couple things to look out for if you're building that fixed income portfolio. Alfred, discount bonds. We're hearing more and more about discount bonds in the DIY channel. A lot of direct investors are seeing them pop up in model portfolios. Can you give us kind of the rundown on what's a discount bond, what's a discount bond ETF, and how does this fit in a fixed income portfolio?
Sure. So as I mentioned before, part of the problem with the fixed income market over the last couple of years is a good part of the market was trading at a premium. Because interest rates were going down, a lot of the bond prices were going up. So as a result of that, they were not very tax efficient. So this is an issue if you're holding bond or bond related investments outside of a registered account. So just as a refresher, for fixed income, you're essentially taxed on that coupon rate, but you receive your yield to maturity. So if you have a coupon rate of 4%, but your yield to maturity is only 3%, that means you're receiving less than you're actually taxed on. So discount bond ETFs are designed exactly to address this problem. Essentially, we buy bonds there where the yield to maturity is at least as high as the coupon. So a good thing is that, over the last couple of months, as the interest rates have gone higher, the universe of discount bonds that are investable have definitely become, a much more robust universe. In addition to that, when you look at discount bond ETFs, when you look at the coupon rate versus a plain vanilla bond ETF, that coupon rate on the discount bond ETF is going to be lower. So it's much more tax efficient. So general rule of thumb, if you're holding bond related investments in a non-registered account, always go for that discount bond ETF if available.
Thanks for running through that. Now, the final consideration for some investors thinking about fixed income ETFs outside of Canada, they can be listed in Canada, but the exposure is perhaps a US exposure. That's the most popular non-Canadian bond exposure available in ETFs. You're going to have to consider your currency exposure as well. So as a refresher, there's 3 currency options for investors when they're looking outside of domestic securities. So you can get an unhedged exposure, where you have exposure to, in this case, the US dollar return as well as your security return. You can have a hedged exposure, which means you're hedging away the currency return, or there's .U ETFs where you can actually buy them and sell them in US dollars and receive your payments, your monthly distributions in US dollars. So if you're looking outside of Canadian bonds, so again, something like a Z-tip, which we've seen has been used a lot this year given the way inflation is going. These are treasury bonds, so of course issued in the US. So investors have those three currency options when looking at an ETF like that. Now, we have a very special guest from Investorline. He has a promotion to talk to us about. Roy, I'd love it if you could tell us about this fantastic promotion for all our viewers.
Excellent. Thank you very much for having me here today. So yeah, very pleased to offer two different excellent promotions. One for our self-directed platform, where for the first 90 days, you get $4.95 per trade. Normally you pay $9.95, so a significant discount there. When you open the account, there is a particular promo code you enter in InvestSmart in order to take advantage of that. As well, with our fantastic Advice Direct platform, you can also get cash back as much as $2,500, depending on the amount of new assets you bring in for that as well.
Thanks, Roy. Now, can you talk to us a little bit about the free trading or commission-free trading list at Investorline and the ETFs that are on that?
Absolutely. So I'm really pleased to say that we offer more than 80 exchange-traded funds through our Investorline platform that you can purchase for no commission. So normally you'd pay $9.95 per trade. With these more than 80 ETFs, that commission is in fact waived. And I'm also happy to say that not only do we offer BMO ETFs, but also iShares and Vanguard as well. Not only fixed income, but we also have equity as well and other types of ETFs. For a full list, in fact, you can go to our Investorline site and pick out your favorites from there.
Thanks for talking us through that. It's a great benefit for anyone using an Investorline account. Now, Roy, if anyone wants to get in touch with you, if they have any more questions about this promotion or anything else, what's your contact information to share?
Oh, yeah, I love to hear from people. My email is roy.tanner@bmo.com. My work number 250-896-4172. Please don't hesitate to reach out. I'm very happy to help.
Great, thanks so much. Write down those promo codes if you're interested, Digital23 or InvestSmart. Thanks so much, Roy, for joining us to give us that promotion.
Thanks very much for your time.
Alfred, we have some questions. I hope you have a few minutes to take them. So our first question came in about high yield. What are your thoughts on high yield right now? How has it been performing so far in 2022?
High yield has definitely been troubled. Obviously, as economic concerns have, or economic growth has, slowed, or expectations have slowed. High yield bonds have definitely felt a lot of pressure. Not only that, but due to higher interest rates as well. So keep in mind when they have to refinance their bonds, they have to refinance at higher rates as yields go up. So obviously, high yield spreads have gone, wider as a result of that. But I think if you're a long-term investor, if you're looking, 5 to 6 years out, when you look at high yield spreads at these levels, definitely not sustainable. But high yield or high yield bond ETFs are definitely a good way to access this asset class. We have a number of high yield bond ETFs available: ZJK, ZHY as the currency hedge version. We also have ZFH, which is essentially a high yield credit spread ETF that provides you with that credit spread, but without any duration exposure at all.
And I will add, the Canadian fixed income market doesn't really have many high yield bonds. So we actually look to the US for this exposure. So our high yield ETFs, bond ETFs, that's why you have the three currency options on them, because they are US bonds. Thanks, Alfred, for answering that. Another question on inflation. So when we're thinking about rising rates and inflation, what types of ETFs can help hedge or mitigate that?
So TIPS, Treasury Inflation Protected Securities, I think you've alluded to during the presentation, but that's a good one. So we have ZTIP, which essentially focuses on the short end of the curve, but also in US Treasury Inflation Protected Securities. And why we chose to focus on the short end is because we want to eliminate that duration risk. Typically, when inflation goes up, central banks respond by raising rates. So you don't want that duration exposure. So you want to focus on the short end. So we have ZTIP, which is the non-currency hedge version. We also have a currency hedge version, ZTIP.F, and also ZTIP.U, which is the US dollar version.
Perfect. Thanks, Alfred. Last question here. On the equity side, so somebody is looking at tech stocks. They're seeing them as the valuations have really pulled back, maybe wondering, is this an entry point? Is there a BMO ETF that holds the top global tech stocks?
Yeah, so tech stocks definitely, another sector that has faced the wrath of higher interest rates. Technology is a sector that is very sensitive to rising rates. But if you believe that interest rates have peaked or inflation has peaked, then technology is definitely well poised or well positioned to take off if that's your belief. We do have a number of ETFs that provide exposure to technology. So we have our NASDAQ ETF, ZQQ, which is the currency hedge version, ZNQ, which is the non-currency hedge version. We also have ZWT, which is our covered call technology ETF. So this one is a very interesting one because it focuses on the more mature tech companies. But in addition to that, what we're doing is we're writing call options against these positions. So not only are you getting exposure to the larger tech companies, but you're also generating yield from writing those call options as well. So an interesting way of playing tech.
Perfect. Thanks, Alfred. Thanks for taking those questions for us. That's it for our show today. Next week, I have Aaron Allen, I have Saad Rana. We are going to go through our ETF due diligence checklist for all of you out there. We talk a lot about doing your due diligence on ETFs, doing your research, doing your homework. Maybe you're wondering what this means. So we're going to go step by step for all the considerations you could be looking for before adding ETFs to your portfolio. So we'll see you next Friday.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.